Wouldn't it be nice to be able to use a valuation model that gives you a fair value for each stock you buy? I mean, the whole purpose of investing is to make money, right? And we all know that if we buy something at a cheap price and then we can sell it at a higher price, well, we are going to achieve this goal. Dividend growth investors, bonjour. My name is Mike Heroux, and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. In this video, we are going to look at the dividend discount model, also known as the DDM. This is a valuation model that is being used in the dividend investing world. I'm going to show you how it is being reflected at Dividend Stocks Rock, but I'm also going to talk about the flaws and the limitation of this valuation model. So we're going to look into Dividend Stocks Rock right away. We're going to look at two stock cards today, Fortis and Microsoft, see how the DDM can be applied or cannot be applied. Let's do this. All right, so right now we are in DSR looking at Fortis dividend stock card. The reason why I've picked Fortis is because it is a very stable utility and it's going to be easier to use the DDM to have a dollar value for this stock price. So Fortis, the reason why I've selected it, well, you can see it is a company that is fairly stable. 99% of its assets are regulated utilities, so the predictable cash flow, the cash flow is highly predictable, so very easy. And from what we can see from the dividend growth history, it grows at a mid-single digit number pretty much every year. It shows over 50 consecutive years of dividend increases, and the past 5 years is at 5.8%. It's really important because the dividend discount model, as we will see right here in the valuation section, will give you the value of all the future expected dividend payment. So the DDM will not tell you if the company will grow, but it will give you an idea as a value if the company is considered as a cash flow making machine generating dividend in the future. So if the business has strong innovation, strong R&Ds, or intended to grow, and then you expect the stock price to skyrocket it because the revenue and earnings per share will grow double digit, this will not be reflected in the DDM. We're just going to consider the dividend payment as of today, plus all the future growth that will come from those dividend payments. So the calculation is quite simple. You need three numbers to use the DDM. The first one is the annualized dividend payment. So what you can do to use it is to use the latest dividend payment, expect that you're going to receive that for the full year, and you get the annual dividend payment. After that, you need to determine or make assumptions on the next two numbers. So the first one is the expected dividend growth rate. At DSR, we use a model with two stages. So we have one dividend growth rate for the first 10 years that is closer to the reality, closer to what we have seen in the past. So you can use the past 5 years, for example, a dividend growth policy. It will give you a pretty accurate number, but then you have to determine the terminal dividend growth rate. So the terminal dividend growth rate is the dividend growth rate that should happen kind of like forever. For Fortis, we have used the same number, but obviously for a company that is growing its dividend by like 8 or 10% right now, it would be unrealistic to expect double-digit dividend growth rate for the next 30, 40, 50 years, right? So for that reason, we would use a more precise dividend growth rate for the first 10 years, so something that is closer to the past 3 or 5 years, and then we would reduce it for the terminal rate just to show a little bit more conservatism in our calculation. So that number is really about current payout ratio, the current state of the business, if there's any growth model, any growth perspective that will enable the company to continue its growth, its dividend payments, sorry. And then you can look at the past 3 and past 5 years annualized growth rate to give you a better idea of like which kind of number you can put in. The next one is even tougher to determine, and it's the discount rate. The discount rate is the expected rate of return that you hope when you invest in a stock or when you make an investment. So according to financial theory, we should use the capital asset pricing model, CAPM, that is based on the expected return from the market, the expected return from a risk-free investment such as treasury bills, and the beta of the company. So you might not want to go into those calculations, and I get it. So I offer a more simplistic view of the DDM using a discount rate of either 9, 10, or 11. Why do I do that? Because first, sometimes when you use the CAPM, you will have a discount rate under 9%. And technically, if you look at the historic rate of the market, we are getting at least 9% a year from the market. So this is pretty much what you should expect. So for companies that are incredibly stable, that are well diversified or well established, I will use a 9% discount rate. When the business shows some flaws, some weaknesses, I'm going to increase the expected return up to 10% because then I want to be compensated for that risk. And when there's a lot of risk, I will use 11% because I really want to be compensated for my risk. So what it does is it will, like, the higher the discount rate you use, the lower the valuation today you will get in your calculation. So here you have the table showing you the difference between 8%, 9%, and 10% discount rate. And as you can see, it goes from $100 as an intrinsic value if you only require an 8% return on your investment on Fortis, 71 if you're requiring a 9%, and then 10% it is at $55. So that means that if you buy Fortis at $55 right now, it's trading at 53 in that example. So you're pretty much buying it at a fair value. Well, then you can expect a 10% return on the dividend payment that you will receive in the future, which is pretty interesting. Here you see that if we use a 9% discount rate, this means that if the stock price trades around $52, $53, you get a pretty good deal. So it's almost a 20% discount price rate here as you buy it or in the 50s instead of like this, the fair value at $70. One thing I want to highlight here is just depending on the discount rate, you can move from a stock that is greatly undervalued to a stock that is greatly overvalued just by 1%. So it's highly sensitive, and this is why it's not the perfect way to determine a value, but it is interesting if you want to compare more than one stock using in the same business model, using the same growth rate, then you'll see which one is trading at a better valuation. Now we're going to move to Microsoft valuation model. The reason why I wanted to show you Microsoft as well is because personally, I prefer to invest in low yield, high growth stocks in general. The low yield, high growth stocks will not work well in the DDM. Why? Kind of intuitive, but since the DDM is giving you a value only on future dividend payment and discard capital gains you can make on buying a stock like Microsoft, because definitely you don't buy Microsoft for the yield, but rather for the total return, the DDM will not work very well. In this case, you can see that while the stock is actually trading above $400, if we go back to the valuation, you'll see that the fair value at the 9% discount rate is $207. So the company is trading twice as much as its intrinsic value, which totally makes sense because we do have a high yield, low growth stock. And even if we use a 10% dividend growth rate for the first 10 years and then a lower one at 7% forever growth rate, we're still not able to find an interesting valuation at this price. We would need to either boost those numbers to a crazy level, which would not make sense because Microsoft is not growing its dividend by 25% a year either, or to require a lower investment return. So at 8%, we would have a pretty good, pretty decent valuation at 419, while the stock price is at 406. So then it would make a little bit more sense. Long story short, if you look at low yield, high growth stock, do not spend much time at looking at the dividend discount model. It's not really working. However, if you look at companies such as pipelines, banks, utilities, REITs, this could be a pretty solid tool to give you an idea of like which stock is the best one in that industry. I would definitely not buy a company just based on the fact that the DDM value is lower than what we see, is higher than what we see on the stock market, or sell one because it's lower. It's just a matter of assumption. So if you're wrong about the discount rate, if you're wrong about the dividend growth rate, then your calculation is completely wrong. So take that metric as with a grain of salt. Do not base your buy or sell investment decisions on the DDM, but it's a great tool if you want to compare more than one stock in the same industry and determine which one has the best value going forward. Always keeping in mind that it's just about the dividend payment and not about the capital growth. If you have any question about the dividend discount model, do not hesitate to reach me at Dividend Stocks Rock. There is that little contact right here form where you can put your message and your email and we will answer right away. All right, take good care and don't forget to stay invested.